Today at iShare, we are joined by a market maker with over 40 years' experience of working in the City of London. Among other subjects, we will talk about making a market, whether there's a potential conflict of interest between being a broker and being a market maker in that stock, and the private investor's favourite subject, market maker games.
Well, let's give an example. Any particular stock, say you've got two market makers. One market maker could be making 100 pence to 105 pence. His competing market maker could be making 102 to 107 pence. That would mean the touch price in the market would be 102 to 105, which means the best bid and the cheapest offer in the market. Market makers make different prices depending on their book position, whether they're long, which means they're a bull of stock, or whether they're short, where they've sold stock that they don't actually own. The driving force behind this will be whether the market maker wishes to buy or wishes to sell. This will be reflected on the price in the market. Generally, market makers will make a price in any given stock depending on whether they feel they're specialist in any area, for example mining, and quite often in these circumstances you'll find that the market maker could also be the broker to that company. Now, having that position as market maker and broker should actually be quite beneficial to the market maker, because brokers will look to see who makes a market in the stock and who the broker to the company is. Now, if you're broker to this company, you should have access to both buyers and sellers, which hopefully they're matched up. It creates an orderly market. The market maker is committed to making a two-way price, one that he'll buy at and one that he'll sell at. And during the course of making these prices, he will, on occasions, build up positions long and short. It is a case of supply and demand, and the market maker will move his price to a level where he thinks he can trade and there is business around. Market making is a very serious business, and market makers aren't there to play games on the screen. What market makers will do, if they feel there's pressure on a stock, they will mark it down to a level where they can actually trade two-way buying and selling. But as far as market maker games, no, I think that's a fallacy on behalf of the public. I won't say that market makers do not look at bulletin boards. Everybody's got access to all sorts of screens these days, but by and large, I've found in the past that some of the stories are quite spurious on these bulletin boards, and if a market maker's got a certain position, whether he's long or short, and he's got limits for buyers and sellers, that fundamentally will dictate what the price does, and not what's put up on a bulletin board. Yes, obviously when an RNS announcement comes out on companies' figures, the market maker will react quickly to the news, and as often is the case, that sometimes it's better to travel than arrive. If you're expecting good figures from XYZ company, the figures come out and they are good, but they're what the market was going for, and you could well see the price of the shares go down because it's already been priced in at that level, and therefore we would possibly expect profit taking, and then you could see the stock gap up, gap down, depending on where the next level of business is. And a market maker will always drive a price to where he can do two-way business. Basically, it is the laws of supply and demand, but market makers will have limits on their book of buyers and sellers, and they will move that price to where there is a two-way business in any given stock. But supply and demand is basically what a market maker will work around. Well, orders would go into the order book at higher levels than the previous evening. Now, depending whether there was any demand, which there should be on a futures opening up, say 50 points, a level will be reached where buyers and sellers can transact, which should be at a higher level. But there could be a situation where market makers may have had stock on their book, they're prepared to sell at not as high a price, and therefore the index could possibly open up maybe just 10 or 20 points. Shorting is when a market maker, or for that matter an individual, sells stock that he doesn't physically own. Now, in doing so as a market maker, this can happen on numerous occasions because supply far outstrips demand. Now, the market maker is committed to making a two-way price, so on that two-way price he may well be selling stock at a certain level, calls the stock up to try and buy it back, but has to sell again. So the market maker is building up a short position, which he doesn't particularly want to do. Most market makers will want to have a square position as much as possible by the time they rule off the books in the evening. So having a big long position where you've bought stock, or a big short position where you've sold stock you don't actually own, it's not an ideal situation for a market maker. So he'll move that price to a level where he can square off his book if possible. Stop losses will be at various levels. It could be at 5% or 10%. So say, for example, the share price is trading at £1. That means you know for a fact you're going to have sellers at 95 and 90. So market makers will move the price to where they think there's going to be some two-way demand, knowing that in a particular case there could be a lot of hot money in the market, and that the market makers will know this from trading over the previous period, and will look to get the share price to a level where they can actually do the business. There aren't market maker games. A market maker is there to make a two-way price from buying and selling, and from his point of view he will always want to have the price at a level where there's two-way business. So there's no games. It is a serious business, and at the end of the day the market maker is there to make money, and you'll often find that through doing business relationships are built up, and there is no reason why the market maker shouldn't be of great support to the private investor.
This film is for educational and leisure purposes only. Proactive Investors does not provide investment advice. The company is a publisher and is not registered with or authorized by the Financial Services Authority. please refer to the full terms and conditions on the Proactive Investors website.